What's up, beautiful people? This is Pope with Stock Doctor Trading. I'm just getting back after licking my wounds and crying over a wet pillow in a corner for the third big prediction I made on this channel. Did not work out for me the other day. If you haven't seen it, go check it out. I was 100% convinced we would get a 50 basis point rate hike instead of the 75, and I went deep. I went real deep on the prediction. So yep, I'm back, done licking my wounds, and I'm sure everybody is done talking about JPow, but I put together like a small clip of what I thought were relevant topics or things that he brought up during his time, to save you the time having to watch the whole thing yourself. These are a series of clues that I think he left us a trail to figure out, pretty much, the probability of what's going to happen, at least the next two meetings. And so we'll cover that. And I just wanted to let you guys know, the markets just closed about 4 minutes ago, and it does look like we're in capitulation season. We lost the 385 SPY level and the 380 level, really quickly. I mean, we broke to 372 yesterday on the initial news from the Fed, and then, pumped up, but that rally lasted all but that day, and we ended the day down 3.26%. So what I'd like to go right now is just some of the highlights from the FOMC meeting, talk about what he actually said, what he clued us in on, and some of the weaknesses that he exhibited from his speech. You're going to see two very, very clear divergences from reality. He's going to have to pick or choose when he's messaging these things to us. Which is it? Is it a strong economy or is it a weakening economy? Is retail sales going down? Did GDP in Q1 not print? Or does he have all the tools that he needs in order to combat this type of inflation? Well, he says he does, and then he says he doesn't. All right, let's take a look, people.
Today, the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong.
FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. Headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation...
Is that the only reason you focus on core, or is it because you don't have any effect on headline inflation?
Is what people experience. They don't know what core is. Why would they? They have no reason to. Spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices. And also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown.
So Q1 GDP was a negative print. He's not seeing can we roll that back one more time? He's seeing a strong economy, but then he's also seeing a weak economy. All right, let's see that again.
Sales going down, but overall,
consumer
spending is very strong. The consumer's in really good shape financially. They're spending
on gas and food.
There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low, but they're probably related to gas prices. And also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see the economy slowing a bit,
and
but
then he
still
says
growth levels, healthy growth levels.
Healthy growth. What is healthy about negative GDP? I mean, that's not growth slowing. That's growth going backwards.
The U.S. economy is in a strong position. Overall economic activity edged down in the first quarter as unusually sharp swings in
This is where
inventories
he's
and
going
net
back and
exports
forth.
more than offset continued strong. Their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong.
Oh, fat
think
chance,
that,
buddy.
What's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And
So wait a second. He said this.
we have both the tools we need and the resolve that it will take to restore price stability.
So he said that he has the tools he needs and the resolve, which is very, very important for a banker to have the resolve. But then he says this, and I'm going to let this just play through. These are all the clips of him flip-flopping on whether or not the Fed actually has the tools in order to do this. Let's just play through.
I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't. The monetary policy stance doesn't affect those things. We have both the tools we need and the resolve that it will take to restore price stability. So, in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to.
He thinks we're going to see like prices come down.
We have both the tools we need and the resolve that it will take to restore price stability. Again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control. We have both the tools we need and the resolve that it will take to restore price stability. But those pathways have become much more challenging due to factors that are not under our control. We have both the tools we need and the resolve that it will take to restore price stability. The sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of. We have both the tools we need and the resolve that it will take to restore price stability. 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took
2% inflation with a strong labor
We have both
market.
the tools we need and the resolve that it will take to restore price stability. Gas prices, all-time highs and things like that. That's not something we can do something about. So we have both the tools we need and the resolve that it will take to restore price stability.
Which is it?
We're
this is the
responsible
gas
for
prices?
inflation in the law, and inflation means headline inflation.
Oh,
So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools.
Okay, you got that right. Like, headline inflation is their mandate, yet their tools only cover core. Far more appropriate to core because all the other stuff is far too volatile, said they who speak with a forked tongue. Let's keep going.
Go into core or are mostly outside the scope of our tools. So we look at that. But, it's.
But I thought you said.
We have both the tools we need and the resolve that it will take to restore. Can we still do it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up
difficult.
taking that option out of our hands. We have both the tools we need and the resolve that it will take to restore price stability. We can't affect, really. I mean, the energy prices are set by global commodity prices. And most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also,
wait, I thought you said you had
things. So we can't really. We have both the tools we need and the resolve that it will take to restore price stability.
Okay.
3.8%, 4% get it done because it gets the job done and breaking the back of inflation.
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean,
We'll
honestly,
know once it's
would
already
be,
happened.
You would have positive
we
real
will.
rates, I think, and
Of course we
inflation
will
coming
know
down by
once
then. I
we're
think you'd
there.
have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're gonna find that out empirically.
Oh, you know what?
We're not going to be completely model-driven about this.
Well, that's a
We're going to be
change.
looking at this,
Flip
keeping our
flopper.
eyes open and reacting to incoming
Flip
data,
flopper.
both on financial conditions and on what's happening in the economy. This is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them.
You really, really have to ask yourself how much confidence you can have in this body when all it was inflation was 0.1% higher than expectation. It was enough for them to change their entire guidance process. And it was enough for them to erode the guidance, the future guidance process on what the Fed's going to do, because now we're never going to trust them. I'm certainly not. Now I'm taking everything as a fork-tongued statement, and I'm looking at economic data, not what the Fed says ever again. They had me for like 6-7 months on that train, and they just took us off that track. So that was a tool they had in their toolboxes that we were going to believe they were going to do exactly what they said they were going to do. So now that they've lost their forward guiding trust and confidence with us, there's going to be a lot more volatility every time they speak.
Anchored at 2%. Provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration
You have
of
to
how
live
well
with
it
the
can work.
guidance.
With us having really just done very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So our guidance is still credible, but it's always going to be conditional on what happens.
It's really clear what the past 6 months was really all about. They were all about spooking us into doing this. You know, they're under the concept that inflation comes down when inflation expectations come down. And so by this sense, this was a whole play where they were trying to do as little as possible while still achieving the highest impact and outcome. And raising to 75 instead of 50, sticking with the 50-50 over this meeting and the last, is basically the white flag being waved, saying that's not going to work anymore. We give up. We have to go more aggressively. This shows it's an absolute failure. They were already behind the 8 ball, and then they sat on this play for 6 months to see if they could just kind of talk us into it. But you can't get a bunch of people that are addicted to free money to just get away from it. A lot of people and companies, their business model is now based on low interest rates and free money. And growth in tech is completely surrounded by that. So the core of this, the veins of this issue run so deep into the salt and the earth of our society that there's not anything that we're going to be able to do to take it out. Okay, let's just watch a little bit further, and then we're going to talk about this peak inflation conversation.
We're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by
You're never
that's what
going
it
to
would take
declare
for us to
victory,
say,
buddy.
okay, we think this job is done. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back.
All right, so when he's talking about the speed in which we get there and that they want to front end load it, I believe that right there is our key indicator from all of this Fed speak about what's happening next. They want to front load this interest rate cycle to give them a little bit more flexibility on the back end of this problem. So that's why they went with 75 bips. And then that's why I believe from this information, it looks like we'll get 75 again. I think if they see inflation meet expectations, they'll go 75. If they see inflation come down in the June numbers in July, then they'll do 50. And anything that's higher than expectations will be 75 and very unlikely to be a 1%. Usually they cut 1% when they want to go down. They don't go 1% straight up. I haven't seen very many moments in history where they've done that. So I thought all of that was interesting. I think we know what we have coming up. And I thought this one last little clip right at the end was really telling. When you have the Fed chairman, JPow, when you have him saying to new home buyers, hey, wait until prices stabilize. That is one of the most bearish signals on the housing market. The dude who's been stimulating this stuff the whole time just said, hey, by the way, probably not a good time right now to buy. Check
I would
this out.
say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels. So thank you very much.
Yeah, so he just said, don't buy a house if you haven't bought a house yet. All right, cool. All right, beautiful people. One last thing that I just need to get out on the table while we move on from this topic. Peak inflation. Okay, when in doubt, zoom out. Let's go ahead and look at the chart for the CPI data for all of our lives and more since the 40s and 50s. Here it is. Is there anywhere on this line that you see a peak? Do you see any peaks? I mean, I think basically when you're talking about peak inflation, you're just talking about today. Whatever today is peak inflation. And then tomorrow will be peak inflation, and the day after will be peak, and the day after will be peak. Look at that. That's a stumble in the road of inflation. And that was the 08 crash, one of the biggest of our generation. And that's just this little bump in the curve. And then boom, we're back up. There's a little bump there. I mean, inflation, people, never peaks. And this whole thing about inflation calming down, so there's just less inflation, that's still more inflation. It's still just going up. Our whole lives, prices just go up. Inflation is never going away, never has gone away. And the only reason the calculation looks like it goes away is because they calculate it year over year. All right, my beautiful people, thank you for getting over that with me. We're going to have some better, newer, more fun topics in the coming days. We have a lot of unsurety coming about, and it's going to be extremely volatile. So get ready, people. And as much as we are bored with all of this Fed talk and the JPow and how much we probably have a little bit of overload on it by now and fatigue, we're actually not done. All right, so Fedspeak starts tomorrow. Next week, several of the board members are coming out, and then on Thursday of next week, JPow, he goes in front of the House on Thursday, and that's probably when we're going to get some real feisty questions from congressmen who are looking to get a vote or two in the upcoming midterms. So we will have to keep an eye out for that. There's a lot more Fedspeak, so that means in your day trading, be careful, because there could be these certain events throughout the day that are just news events that are driving the market. So make sure you keep an eye on the market while you're doing your trades, people. Good luck. See you on the moon. By the way, if I could invest in CPI, I'd be on the moon by now. This is like, seems like the greatest investment of all time. It's better than the S&P. All right, people. Don't get yourselves in too much trouble out there now. Peace.